Hey, what's up, everybody? It's Tuesday, June 7th. The market was higher today. Came off that morning weakness, so it's a good sign. Once again, we see that the selling got repulsed. And, well, we could see some more of that back and forth action in the near term. And don't forget, next week, Wednesday, that's the big day, the Fed meeting with a rate hike of 50 basis points. That's already priced in. We're going to have a press conference, and Powell probably going to go off real hawkish on that one because Biden told him to be hawkish. And we're going to see the first securities in the Fed's portfolio start to roll off next week. So the dreaded QT is going to actually get going. Frankly, as I've been telling you, I can't wait for this stuff. And you know my reasons. And it's basically because everybody is super bearish and they're freaking out. They're freaking out about tightening and they're shrinking the money supply and all that. It's just a bunch of nonsense, man. Like, nobody understands this stuff. It's just a big asset swap. You know, more securities, less reserves. It's the same money in the system, just in two slightly different forms. And by the way, you know, the bulk of what most of us call money, me and you, I mean, that's really like bank credit. And we'll probably see an expansion in the bank credit as banks get more room to lend. You know, when reserve assets go down, they got more room on their books to lend. Like, nobody's telling you that. I'm the only one telling you that. So remember, you know, when we're talking about surging credit growth down the road, remember who told you about that. You know, if I have any disappointment right now is that the Fed is starting out with this so slow. I mean, they're only going to be doing $47.5 billion reduction in the first 3 months. You know, that's on, you know, they got a $9 trillion portfolio. So, like, that's like a fly on an elephant's ass. You know, I want to see them get going to the $95 billion per month. And even that, it's not a lot, but, you know, it should have an effect. Hey, folks, here's what I want to talk about. People are still really bearish out there. I went to YouTube today, and as soon as I went to the site, like, I was bombarded with a bunch of videos about, you know, recession and market crash and liquidity crisis is coming and we're going to have another 2008. So I clipped out a couple of these things. I'm going to show them to you. So here we go. Let's check them out. Here's the first one. The guy's saying, banks are preparing for a 2022 recession. No more loans. Well, I don't know about you, but my mailbox has been stuffed with loan offers. Like, they just keep piling up. Day after day after day. I mean, just keep getting more and more. So I'm kind of skeptical about the no more loan stuff because, first of all, as I said earlier, you know, the Fed's balance sheet reduction, when they start doing that, you know, that's going to result in a drop in reserve assets on the books of the banks. And that's going to allow the banks to create more loans, not less loans. But don't expect that you're going to hear it from these YouTubers. I mean, they just don't understand this stuff. So you got that one. Here's another one. There's a market crash coming and it's going to get ugly. Now this guy, this video, apparently he quotes or interviews that Rich Dad, Poor Dad guy. I don't know. I don't think that Rich Dad, Poor Dad guy is much of a stock market player. But the other guy, the host, the interviewer, says it can happen in 6 months, or it can happen in 12 months, or it could happen in 2 to 3 years. So take that for what it's worth. But it's coming, he says. He doesn't really give any reason other than, you know, we just have to have a correction. We have to have a crash. We have to have a recession. Just have to have one. And here's this guy who said the Fed is about to unleash a massive liquidity crisis. Again, folks, it's just a lack of understanding. It's an asset swap. More securities, less reserves. It's not a loss of liquidity. And, you know, anyway, right now, think about it. The banks are sending a record amount of reserves to the Fed's reverse repo facility just because they don't even want the reserves. They don't want them on their books. And like I said earlier, what is liquidity anyway? For most of us, it's credit. It's bank credit. So to the extent that the credit starts flowing even faster now because banks are not burdened by these useless excess reserves, That's going to be an increase in liquidity, not a decrease. So you have that one. Now here's this one. And this guy cites falling job openings, and he says layoffs are next. And, you know, maybe that's true. I don't know. Although there's no sign of that yet. I mean, we just saw a pretty strong job report last week. What was it up, like 390,000 or 395,000? Initial claims for unemployment insurance still like historically low. It's like at a 40 or 50 year low, very close to it. Finally, there's this video. Michael Burry just predicted the unthinkable. For those of you who don't know who Michael Burry is, that guy's actually a physician. He was portrayed in the movie The Big Short. Now, this guy shorted subprime back in like 2005 or 2006, and as the story goes, he made a big profit. So, I mean, you know, good for him. But another 2008, I'm not buying it. I mean, look, we got different conditions now. And this is not 2008 all over again. I mean, for one thing, fiscal support now is massively higher than what it was in 2008. Household debt burdens, remember I've been talking about this a lot. Household debt service burdens, they're near record lows right now. In 2008, they were at record highs. And, you know, the Fed and regulators, they learned a lot of lessons since 2008, things that they were clueless about back then. So, I don't know, I just don't see another 2008 happening, another Lehman crash, that sort of stuff. I just think it's a different situation now, different conditions. I tell you what I didn't see on YouTube. I didn't see any videos about, you know, how the economy might be okay, how maybe we might muddle through, yeah, at a slow growth rate, but still growing. I didn't see any videos about how maybe oil prices might stop going up or even come down a bit because OPEC is increasing its output. I didn't see any videos about how stronger pricing power at the firms is going to lead to higher profits. Like, I didn't see anything like that. All I saw was bearishness and doom and gloom and hyper fear-mongering, and, you know, there's going to be a crash, and it's 2008 all over again, and this is going to be the worst thing, you know, in a generation, or one guy says the worst thing in his life that he's ever going to see. I mean, I just don't see that. I don't see that. As I've been telling you guys, you know, fiscal flows are the two things that really are the most important. Fiscal flows and bank credit, and both of those things are moving in a positive direction. And as a matter of fact, bank credit, like I said, once we get this Fed balance sheet reduction and reserve asset reduction, you know, we could see bank credit go into hyperdrive. I mean, right now it's accelerating. I mean, most of these bank metrics, forget about nominal levels of loans and stuff like that. That's at a record high. Those have been at record highs. But I mean, the rate of growth has just been phenomenal and accelerating across all, you know, segments of loans. So, I mean, I just see this getting better. Anyway, we'll see what happens. It's going to be a fun, next week's going to be a fun week. But like I've been telling you, I can't wait for this stuff because I think I'm the only guy out there talking about this, you know, about seeing this in a positive way, and I'm giving you reasons for it. Anyway, that's it for today, folks. See you tomorrow. Bye.